One of the most common questions homeowners ask after buying a property is whether they can refinance using a higher appraised value once improvements are made. And this usually comes up after someone has owned the home for a short time, but put money into upgrades and then starts looking at interest rates, monthly payments, or rolling closing costs into a new loan. The assumption is if the home is worth more now, the refinance should be based on that higher value. With FHA loans, that assumption can create confusion if the timing and documentation are not fully understood. So let's walk through how FHA actually treats value on a refinance, what the waiting periods really mean, and why the difference between being eligible to refinance and being able to use a higher appraised value matters more than most people expect. This scenario is incredibly common with FHA borrowers. Someone buys a home using FHA financing, often because the program offers more flexibility on credit, down payment, or debt-to-income ratios. And after closing, they may replace flooring, update kitchens or bathrooms, maybe improve landscaping, or make functional repairs that clearly improve the property. And then a few months later, interest rates shift, or maybe monthly payments feel a bit tight, or the homeowner wants to roll closing costs into the refinance rather than bringing cash to the table. So at that point, the question becomes whether FHA will recognize the higher value created by those improvements, and the answer depends on how much work was done and more on timing and documentation. FHA has a concept called valuation seasoning that applies to refinances. This rule exists to prevent inflated values from being used shortly after a purchase and to ensure stability in how loan amounts are calculated. For properties acquired within the past 12 months, FHA limits how much value can be used when calculating the maximum loan amount on a refinance. So during that first 12-month period, FHA requires the adjusted value to be the lesser of two numbers: the original purchase price plus the documented cost of improvements made after closing, or the current appraised value. So if improvements were made but the borrower cannot document the cost with receipts, invoices, or contractor proof, FHA does not allow those improvements to be added to the value calculation during that first year. So in that case, the refinance is capped at the original purchase price, regardless of how much the home might appraise for today. FHA does not dispute that improvements can increase value. What FHA requires is proof. During the first 12 months of ownership, the only way to use a higher value is to document the actual cost of improvements made after purchase. Without receipts, FHA has no mechanism to distinguish between market appreciation and undocumented value changes. So because of that, FHA defaults to the safest benchmark available, which is the original purchase price. This is not a penalty, it's risk control. So once that 12-month window passes, the rules change. Now, this is where many borrowers get tripped up. FHA allows borrowers to be eligible for certain refinances before 12 months have passed. After 6 consecutive monthly payments and 6 months from the first payment due date, a borrower may be eligible to apply for an FHA simple refinance, or like an FHA rate and term refinance. So eligibility simply means the borrower can apply. Valuation determines how much loan amounts FHA will allow, and those are not the same thing. So if a borrower refinances between 6 and 12 months without documented improvement receipts, FHA still limits the valuation to the original purchase price. So while the refinancing may be allowed, the higher appraised value cannot be used yet. This distinction becomes especially important when borrowers want to roll closing costs into the new loan. So to include closing costs in an FHA refinance, the loan must be structured as a simple refinance or rate and term refinance, both which require an appraisal. So streamlined refinances do not require an appraisal, but they also do not allow closing costs to be rolled into the loan amount in the same way. So if a borrower refinances before 12 months without receipts, the loan amount is calculated using the original purchase price, which limits how much can be financed. That often means bringing cash to closing or waiting longer. Once 12 months have passed from the purchase date, FHA no longer applies the same valuation restriction. So at that point, the refinance can be based on the current appraised value, even if improvements were made without receipts. So this is because the seasoning period has been satisfied. FHA is now comfortable using the market-supported value rather than anchoring to the original purchase price. So for many borrowers, this timing is what allows closing costs to be rolled in, monthly payments to be reduced, or loan structures to be adjusted without bringing additional cash cash to the closing table. Special caveat here, if you used a down payment assistance program to originally purchase the property, oftentimes those are structured with silent second liens that will have to be repaid if you sell or refinance within 3 to 5 years of your original purchase. So just keep that in mind if you're trying to refinance sooner rather than later, because those funds would likely have to be paid back. Make sure to check the fine print on the documents of what you agreed to know what you're getting into. It's also important to separate this discussion from cash-out refinances. The guidance you might have referenced from Fannie Mae applies to conventional loans, not FHA. So while Fannie Mae is absolutely a trustworthy source, those rules govern conventional financing and do not override FHA policy. So FHA cash-out refinances have their own seasoning, equity, documentation requirements, which are separate from conventional guidelines. So for this discussion, the key takeaway is that FHA valuation rules on refinances are not interchangeable with conventional rules. Each program stands on its own. Most frustration around this topic comes from mismatched expectations. Borrowers assume refinancing eligibility automatically means access to higher valuations. They assume market appreciation alone is enough, and they assume that improvements speak for themselves. FHA simply does not work that way in the first year. So once borrowers understand that timing controls valuation, decisions become much clearer. If you've purchased a home with FHA and made improvements, planning your refinance timeline matters. So if you have receipts, refinancing earlier may make sense. If you don't, waiting until the 12-month mark may give you far more flexibility. Neither option is wrong. What matters is understanding the rule before committing to a refinance strategy. These rules are not intuitive. They don't show up clearly in rate quotes or online calculators. They require someone who understands FHA guidelines, not just refinancing in general. So handled correctly, these timing rules protect borrowers. Handled poorly, they can create some pretty nasty surprises. So that difference usually comes down to experience. FHA allows borrowers to refinance after 6 months, but that does not automatically allow the use of higher appraised values. Without documented improvement receipts, FHA requires a full 12 months of ownership before the current appraised value can be used. So understanding that distinction early prevents frustrations, delays, and unnecessary out-of-pocket costs. If you're thinking about refinancing an FHA loan and want to understand how timing, valuation, and loan structure affect your options, use the link below to book a call with my team. Getting clarity early can save time, money, and stress later. And if you want clear, reliable explanations about FHA rules, refinancing strategies, and how these guidelines affect real decisions, make sure to hit that subscribe button. My goal is to help you make informed decisions with confidence and ultimately win with Wade. We'll see you next time.